Hello everyone, welcome to our channel. Now we are going to discuss December 2025 Management Accounting Suggestion Answers. So let's start with section A. Which of the following option is not a characteristics of management accounting? Future-oriented accounting information, compulsory accounting, management-oriented. So here, management accounting relates to decision making. So it is obviously related to future oriented. And we will be having some kind of accounting information and purely related to management oriented. But management accounting is not compulsory accounting. So the correct option is C, compulsory accounting. Second question, which personnel of a financial firm play a key role in management accounting? So in management accounting, managers will play a vital role. So option B is the right answer. Production details of Barney Food Care or as hunters. So you will be having production units A, B, C, D. So we have 4 products. Machine hours per production run 50, 40, and 30 and 40. So units are produced in production run of 10 units. So this is the key point here. So in one production run, we will be producing 10 units. If activity cost pool during the period is 2,25,000 rupees and overheads or absorbed based on machine hour rate, the rate per cost driver is. So this is based on activity based costing. So now we need to calculate rate per cost driver. So we are having details of production. Using one production run, we can produce 10 units. So for producing 1,000 units, we require 100 units of 100 production runs. So let us calculate here. So I need to produce production of 1,000, 1,100, 1,200 and 1,500 respectively. So in one production run, I will be producing 10 units. So here I required to calculate number of production runs. That is 1,000 divided by 10 in this case. So I will be getting 100 here, 110, that is 1,100 divided by 10, 1,200 divided by 10, and 1,500 divided by 10. So this is my production runs. Further, they have given machine hours per production run. So for one production run, I require 50 hours. So my machine hours 50, 40, 30, and again 40. So how many hours required totally? So total machine hours required. That is 100 into 50. So 5,000, 110 into 40, 4,400, 120 into 30, 3,600, and 150 into 40, 6,000. So totally I require 19,000 hours. So here for this 19,000 hours, we have total overheads of 2,25,000. So now I need to calculate overhead rate based on machine hour rate. So cost driver will be based on machine hours. So cost driver rate, that is overage divided by machine hours. So total overage divided by total machine hours. So 2,25,000 divided by total machine hours is 19,000. So I will be getting 11.84 approximately per hour. So the correct option is 11.84. So let's move on to next question. In activity-based costing, an item for which cost measurement is required. So in the sum itself, we saw for which cost measurement is required for units, right? So for cost object, we need cost measurement. So cost measurement will be done for cost object. So Bishu Limited sells two products A and B in the ratio 3:2. Variable cost as percentage of sales for product A and B is 95% and 90% respectively. If total fixed cost is 7,000, break-even point in rupees for Vishnu Limited is. So we need to calculate break-even point in rupees. Fine. So what is the formula for calculating break-even point in rupees? So we need to calculate break-even point in rupees. That is fixed cost divided by PV ratio. So here fixed cost and PV ratio we will be requiring overall, not individual projects. So here we are having ratio for A and B as 3:2. That is sales ratio. So sales mix is 3:2. So let us assume I am selling total value of sales is 100. So this is based on assumption only. So this question we can do only based on assumption. So total sales value, that is revenue, or else you can assume sales revenue is 100 rupees. Then for A you will be having 100 into 3/5. That is I am splitting based on this ratio. And for B we will be having 100 into 2/5. So we will be having 60 and 40. Here they have given variable cost as percentage of sales for product A and B is 95 and 90%. So that is variable cost percentage they have given 95 and 90 percentage. So obviously my contribution will be here in this case, that is if variable cost is 95%. That means in sales 100%, I will be getting 5% of my contribution. So contribution amounts to 6 into 5%. So I will be getting 3 rupees as contribution. And in this case, 10%, that is 14 to 10%, 4 rupees as contribution. So total of 7 rupees as contribution for 100 rupees revenue. So my overall PV is equal to contribution divided by sales into 100. That means 7 divided by My sales I have assumed here as 100. So into 100%, that means 7% will be my PV ratio. So now what is the formula for calculating BEP, fixed cost divided by PV ratio? My fixed cost mentioned in the question as 7,000 rupees. So 7,000 divided by 7 percentage. That means I will be having 1 lakh rupees as BEP. So right option is A, 1 lakh rupees. So I guess it is very clear. So here they have given variable cost percentage. So PV ratio is nothing but my contribution, right? So that means 95% of suppose it is variable cost means remaining 5% is my contribution. And here 90% they have given. So 10% will be my contribution. Let's move on to next question. A company sales decline from 9 lakh rupees to 7 lakh rupees, causing a profit of 50,000 to become a loss of 50,000. What is the company PV ratio? So here they are given two variables for sales, that is change in sales and change in profit. So based on this only we can able to calculate PV ratio. So another formula for PV ratio will be useful for this. So PV ratio is equal to change in profit divided by change in sales. So here I'm having sales that is 9 lakh to 7 lakhs. If it is reducing, that means change in sales. Here it is reducing, right? 9 lakh to 7 lakhs. So that means here the sales is reduced to 2 lakh rupees. Now let's see profit. Change in profit. So the profit is causing a profit of 50,000 to become a loss of 50,000. Now at this stage in 9 lakhs, I'm getting a profit of 50,000. So my formula is 50,000 minus another profit. But in this case, I'm getting a loss of 50,000. So minus 50,000. So I will be, net impact will be 1 lakh rupees. So here the crux is minus 50,000 minus again minus 50,000. So I have to incur a profit of 1 lakh. Then only this 50,000 loss will become to profit of 50,000. So many of us will miss this. So here change in profit will be 1 lakh rupees. So let's apply in this formula. So my change in profit, that is 1 lakh divided by my change in sales, that is 2 lakhs. So we will be having 0.5, that is 50 percentage. So option C is the right option. So or else here itself you can make it as into 100. So you will be getting 50 percentage. So let's move on to seventh problem. ABC, a manufacturing company, is evaluating two machines for its production line. The associated costs are as follows. So here we are having two types of machines, semi-automated and fully automated, and variable cost per unit is 10 and 4, fixed cost is 12,000 and 30,000. Based on a total cost analysis, which of the following decision is correct? So they are asking cost analysis. So which one to be a right option? So here, if I'm seeing the options, I can understand semi-automated should be chosen if the expected production is 2,500 and they are giving the options based on which machines should be chosen for which units. So for this type of questions, we need to calculate indifference point. So let us calculate indifference point. So indifference point, that is change in fixed cost divided by change in variable cost per unit. Remember here, I need to calculate variable cost per unit. So here, what is the change between two options? Fixed cost, that is, here it is 30,000, here it is 12,000. That means 18,000 is the difference, right? So, change in fixed cost, that is 30,000 minus 12,000. So I will be getting 18,000. Now I need to calculate what is the change in variable cost per unit. So variable cost per unit is 10 and 4. So 10 minus 4 is 60,000. So variable cost 10 minus 4. That means 6 rupees per unit. So let us apply in this formula. So fixed cost is 18,000 divided by 6. So here I'm getting 3,000 units. So the result is in units, that is 3,000 units. So indifference point is 3,000 units. Now we need to remember one important rule here. So if a machine is producing less than 3,000, so less than 3,000 units, that is my indifference point. So what is indifference point at this point? There is no difference between both the machines. If I am producing 3,000 units, either it is semi-automated or fully automated, my cost will be same. That is indifference point, right? If it is less than 3,000 units, so the machine with lower fixed cost will be preferred. So lower fixed cost will be preferred. So always remember this point. So whenever you are calculating indifference point, so if it is less than indifference point units, whatever, if it is for machinery, we should consider lower fixed cost. So if it is more than 3,000 units, then we need to consider the machine with lower variable cost. So here in this case, the semi-automated machine should be chosen if the expected production is 2,500. My indifference point is 3,000 units. So, but here we are producing just 2,500. It is less than indifference point. So, machine with lower fixed cost will be preferred. So, obviously, semi-automated machines is having lower fixed cost. So, this will be preferred. So, option A is the right answer. So anyways, you can check for another options also. So if it is 2,500 units, fully automated machine should be chosen. Obviously, this is wrong. So if it is 3,000 units, 3,500 units, the semi-automated machine should be chosen. If it is 3,500, I will be choosing fully automated. So option C is also incorrect. The choice between machines does not matter if production is 3,500. The choice between machines, that is my indifference point, right? Then only it doesn't matter. So my indifference point is 3,000 units, but whereas here it is mentioned as 3,500. So option D also incorrect one. So option E is the right answer. The machine or semi-automated machine should be chosen if the expected production is 2,500 units. Which of the following is not a method of transfer pricing? So for transfer pricing, we will be using based on total cost, marginal cost, and market price. But skimming price is here pricing methodology and not for transfer pricing. So option C is the right answer. A company's budget and the actuals for a period are as follows. So budgeted production 6,000 units, budgeted variable overhead 1,20,000, standard time for 1 unit 2 hours, actual production 5,900, actual overheads incurred 1,22,000, actual hours worked 11,500. Now we need to calculate variable overhead cost variance. So here we need to calculate standard rate, that is variable rate per unit. So let's calculate standard variable rate per unit. Standard rate per unit. So here I'm having standard, that is budget of 1,20,000 units for 6,000 units. 1,20,000 for 6,000 units. That means 20 rupees per unit. Now, how many units I have produced? So here I am producing 5,900 units. So that means I am recovering. So recovered overhead is 5,900 into 20. That means 1,18,000 I am recovering. Now let us compare these two. So variable overhead cost variance. What is the formula for this? Recovered overhead minus actual overhead. It's very simple. Variable overhead cost variance. Recovered overhead minus actual overhead. So remember, for all the cost variance, if it is less than the standard, it is favorable variance. So standard will be coming first. So here recovered is 1,18,000 minus my actual variable overhead, that is given in the question 1,22,000. So here we are getting in adverse, that is 4,000. So 4,000 adverse is the right option. So or else you can calculate in another manner also, that is standard rate we are having, right? So in here itself you can measure standard rate into actual output minus actual overhead. So anyway, standard rate into actual output is said to be recovered overheads. Let's move on to next question. N-Store Limited produces 500 units of product A in 12 hours per unit against standard hours of 16 per unit. If standard rate per hour is 48 rupees and actual rate per hour is 52, then labor efficiency variance. So we need to calculate labor efficiency variance. So efficiency is nothing but your time, how efficient you are producing, right? So here my formula will be, so labor efficiency variance is equal to, I require time here. So the formula will be difference between standard time and actual time will be considered into my standard rate per hour. So here, do I have standard time? So here they are saying standard time is 16 per unit, but here they have taken 12 hours per unit. My standard rate per hour is 48. So 16 minus 12 into 48. So here I'm having 192 as labor efficiency variance. This is for 1 unit. So I want to calculate for my actual production is 500 units here in this case. So I want to calculate for 500 units. So 192 into 500. So I will be end up with 96,000 rupees as adverse variance, or else in this manner you can calculate easily. Since this is MCQs, you can calculate within 1 minute, or else you want to calculate what is the standard time for your actual production. So standard time for actual production. This is an alternative way, minus actual time into standard rate per hour. So here I need to calculate standard time for actual production. So my standard time for 1 unit is 16 hours. So actual production is 500 units. So 16 into 500. So I will be getting 8,000 hours. And my actual time. So actual time is 12 hours. So again, you need to calculate actual time. That is 12 into 500 units. So we will be getting 6,000 hours. So now applying this formula, that is 8,000 minus 6,000 into my standard rate is 48 rupees per hour. So I will be getting 2,000 into 48,000. So I will be getting 96,000. So time consumption will be more in this type. So I prefer you to choose this one. Anyways, you want to multiply this with again 500. So instead of multiplying here 2 times, here in this step you are multiplying only once. So this will save your time. So here 96,000. This is coming in. So compared to standard time, we are producing in a less time. So this is favorable variance. So 96,000 favor. That is option A is the right answer. So E is a budget which is continuously updated by adding a further accounting period when the earlier accounting period has expired. So if we are adding next accounting period, then it is said to be rolling budget. So right option is rolling budget. Yeah, division of a company has operating assets 5 lakh and generates an operating income of 1 lakh rupees. So if the company's minimum required rate of return is 15%, what is division's residual income? So residual income, that is RI, is equal to my operating profit minus my capital charge. That is how much I am expecting. So here in this case, my operating income, they have given us 1 lakh rupees and I am expecting 15% rate of return on my capital employed. So my capital charge is 5 lakh into 15%. So capital charges 5 lakhs into 15%. That means 75,000 is my operating charge. So my RI is equal to my operating income. That is mentioned in the question, that is 1 lakh. So 1 lakh minus 75,000. So 25,000 is my residual income. So option C is the right answer. So residual income is how much I am earning more compared with my expectation. So my expectation is 15%. So 5 lakh into 15%. So my expectation is 75,000, but I am earning an income of 1 lakh. So my residual income is 25,000 rupees. Which one of the following responsibility centers is an organizational unit whose manager is responsible for generating the revenue? So here important is generating revenue and managing expenses related to current activity. So who is responsible for generating revenue and managing expenses for current activity? That is profit center. So yeah, business is deciding between three different options, A, B, and C. The profitability of each option depends on four possible economic scenarios: recession, stability, growth, and boom. How many unique payoff values will exist in the payoff table for this decision problem? So we are having three different options and four scenarios. So 3 into 4, 12. So 12 unique payoff value will be available. So next, move on to next person. Two investments projects have the following characteristics. So they are given expected return for A and B, standard deviation of return. So this project is relatively riskier. So they are asking which project is riskier. Since here 20% return I am getting, but standard deviation is 15%. So I can't say this project is riskier because I'm getting expected return. Also, my risk is getting high. At the same time, my return was also getting high. So I need to calculate coefficient of variance. Coefficient of variation. So let's calculate for project A. So what is the formula for calculating coefficient of variance? That is my standard deviation divided by expected return. So my standard deviation here is 15 divided by 20. That is 0.75 for project B. My standard deviation is 9 and expected return is 10. So 9 divided by 10. So 0.9. So project B is riskier than compared to project A. For I want to take a risk of 0.9 for earning an expected return of 10%. So project B is riskier. So option D will be the right answer. Project B, because its coefficient of variation is higher.